Welcome to the Self-Directed Edge, the podcast for investors who want their retirement capital doing more than sitting in the market. I'm your host, Joel Landon with Heritage IRA. Each episode, I sit down with operators, fund managers, and alternative asset specialists to break down the strategies, asset classes, and opportunities that self-directed IRA and Solo 401k investors are actually using to build wealth outside of Wall Street. We're talking real estate, private credit, precious metals, and everything in between. The kind of investing most people don't even know their retirement account can access. This isn't investment advice, it's education. Let's get into it. Okay, welcome back, everybody. Joel Landon here from Heritage IRA. I've got a good friend that I've known for a while now, Nick Stromwall, joining us today. And I'm excited about him being here because this is essentially us kicking off a recurring recording for you, our audience. And so what I thought I'd do is bring Nick in and give him a chance to talk a little bit about himself, his background, and then ultimately I'm going to hit him up with some questions that he can answer for us. So Nick, thank you so much. I'm going to let you take it away.
Yeah, awesome. What a privilege to be here. Excited to help the community. The cool thing about this alternative real estate space is there's just so much information and so many great leaders to learn from. So I feel like as much as I'm here, contributing, I'm here learning just as much as well. Just quick background on my, who I am. Have been in the real estate world for really the last 20 years. Started off by purchasing some single family duplexes, Airbnbs, had a small portfolio, had a growing family, and realized it was really hard to both kind of be present as a husband and father in my work, and then as well as managing multiple properties. So went more on the passive route, learned about commercial real estate and syndications, and now have been a fund manager and also a capital raiser really for the last 4 years. So I've identified really great best in class sponsors across multiple asset classes and have developed a network of really impact focused investors that want to not only multiply their money but maybe even more importantly multiply their impact. So excited to share some of the things that I'm learning in the space here today.
Awesome. Thank you so much, Nick. I appreciate you sharing that. And why don't we just jump right into it, get into the meat and potatoes, and hit you up with some questions here. Take your time and answer these based off your experience. First one is, what trends are you watching most closely in multifamily or in the multifamily market today, and how have those trends changed over the last year, 2 years?
Yeah, I think the biggest thing is a new shift towards more of an operational value add. And what I mean by that is, in general, in a multifamily space, the value add space, which is, buying older apartments that need some love, putting some money into those, raising the rents because people are willing to pay for a nicer place to live. That's kind of been the business plan for a long time, but I'm seeing a lot of people in the space, and what we're doing is more of an operational value add where we're able to just leverage our size. We now manage over 12,000 units across our three markets, and we're able to go to our suppliers of internet and telecom and streaming services. And instead of our individual residents setting up contracts with them, everyone wants recurring revenue. So we've been able to help our partners by building in those costs into into the lease of our agreement with our residents, and then we're able to negotiate better services for our tenants, more additional streaming services, additional packages, and it serves our partners because they can have more recurring revenue, and then we actually get a blessing of that too with a larger profit share. So that's just leveraging our size, and I think that's a huge win for a lot of people in the space. I really think we've hit the bottom of the market, and really the next 12 to 18 months I believe will be one of the best buying cycles for the multifamily space. So as a prospective investor, this might be one of your best opportunities to jump into multifamily. A lot of my investors love multifamily because it provides consistent cash flow. We pay monthly distributions, typically 60 to 90 days after we close. You also get the upside and the appreciation of the property. So two ways to grow your revenue source. One is the organic rent growth. So a lot of cities have seen negative organic rent growth, but that tide is turning now to a positive organic rent growth, meaning there's not a lot of new deliveries of new apartments coming online. So as more and more people move to certain areas, we like Phoenix, we like Dallas, we like North Carolina, more and more people are moving to those places. There's not enough, supply to meet that demand, therefore prices go up. So that's one way to force growth. The other way to force growth is the value add. So you put some money into each individual unit, people will pay for a nicer unit and you can force appreciation that way. And then the third way I love multifamily is you got that cash flow, got the appreciation, and then we're seeing some awesome tax saving potential now through a cost segregation study and through depreciation. So those three areas have been, one reason I love multifamily.
That's awesome. Thank you, Nick. And I'll just add first and foremost, I appreciate that information, super insightful. Those listening right now, this is obviously an asset class that you can invest in with an IRA. You could do that with the solo 401k. You could even invest in these assets that Rise 48 offers as an individual. It's not just limited to IRA investors. So really, really nice opportunity for any one of those investment entities. Another question I wanted to ask you, when evaluating a multifamily property, and you talked about the markets that you guys prefer, what are the top three things your team looks for before deciding to acquire it?
Yeah, day one, cash flow positive. So we're typically targeting opportunities where it's 90% or more occupied. And, we were looking for that day one cash flow positive type of situation. So if we can solve someone's problem who's trying to sell, a couple examples, out of the country owners. Uh, Groups that are trying to liquidate a portion of their portfolio in one geographic area to move to another one. Really common one right now is someone's loan is coming due, it's maturing, and they have to sell before a maturity date. So we're able to come in and offer, a fair and market rate. But we're often not the highest offer out there, but we've really established ourselves as a group that has a 100% close rate. So if a prospective seller needs to sell, the Rise 48 offer tends to go to the top of the service. So cash flow positive, we're looking for areas where there's more and more people moving to because there's great jobs being formed there. We're looking for typically red landlord friendly states that just allows us to operate with all the different operational efficiencies that we need. And then, desirable areas. A couple of our last properties have been right along some nice park preserves. These are areas where people want to live. For example, in Raleigh, I think the median sales price of our home now in the area that we've recently purchased in is $600,000. For a lot of first-time home buyers, that's just out of the price range, number one, for their current, income levels. And then number two, with where the pricing is for loans, it's just a little bit out of reach for some people. So we want to provide not only affordable but also desirable places with the amenities that people want, whether that's a fitness center or a pool facility or a dog park or a playground facility. The things that people really want, those are the types of assets that we're looking to acquire.
Awesome. Every investment has its risks. There's no question about that. But what are some of the biggest misconceptions investors have about commercial real estate, and what risks should they understand before investing?
Yeah, I mean it's technically always possible to lose your investment, and that might sound like a scary thing to say, but it's always a possibility. Worst case scenario is always all of your tenants lose their jobs, they can't find a new job, and you can't find new tenants to replace them. That would be kind of worst case scenario. We're mitigating that through our business plan by finding areas where there's lots of people moving to because there's great jobs and great opportunities, and we're not necessarily worried about that being the main cause. I think sometimes, some groups, purchase buildings and they don't quite understand the full life cycle of the asset. Some people are doing it more for a buy and hold, kind of hold it forever. we're all about the velocity of money. So if we can get our investors, their projected return before our 5 year hold period, we're typically targeting roughly a 2x return in 5 years. But if we could hit a 1.6 equity multiple in 2 or 3 years, we'll look to sell that deal all day long because we want to help our investors really steward their capital and grow it and multiply it. And our deal flow is so good. We're typically transacting on 8 to 12 deals per year, that we know that there's going to be another deal around the corner. So if we can take someone's capital, be a good steward of it, multiply it, carry it forward, then the hope would be that those investors would want to invest with us again.
Right on. And you brought up returns. In general, many investors focus heavily on projected returns. In your experience, what are the most important indicators of downside protection in multifamily?
Yeah, I think for groups that are using variable interest rate loans, that they mitigate that with a rate cap. So we typically buy a 3 year fixed rate, right around the 4.75% range is kind of where we're targeting. And that allows us a couple kind of unique features. A lot of times when you have fixed rate long-term debt, if you execute your business plan, it goes really well and you want to exit early, you often have to pay an early payment penalty, also called defeasance. With a lot of the variable interest only loans, you actually don't have those early prepayment penalties. So if we're able to execute our business plan in 18 months instead of 3 years, and it's opportunistic to sell in 18 months, we can do that while still maximizing investor returns. I think, having multiple levers in your underwriting is also important. So if we wanted to go to a fixed rate product after we executed our business plan, we underwrite our deals so that we can do that. And then, having healthy reserves when you purchase the property at a property level also give you more flexibility and room. If you discover something, or if the market crashes, or if something happens in the future, having that property level reserve that's not tied to a new roof or capital expenditures is really important. So we found those three things to be helpful. And then I think on top of that, groups that are focused both on protecting investor capital and mitigating types of risk, but also really serving the people at the building. I'm going to an event in a couple days. We're just calling it Serve Day. Some of our investors are flying into one of our properties. Some of our key partners are going to be there. We're going to have the fire truck come out. We're renting a bounce house. We're having some food trucks there. And it's just going to be an event to just love on the people in our building. A lot of our buildings have families and kids. And when you can focus on raising the people by just providing sources of community. Food is always a great way to do that, but we do back to school drives, and we do, backpack drives there. We do Easter egg hunts and different things. And those events aren't just, let's put it on the calendar to do something good, but when you create community at your buildings, I think the stat is people typically in these buildings have two friends or less. So if you can create a context for community, people get to know each other, then they're going to invite their friends to come live at the building, and they're probably going to want to renew their lease and live there longer because they actually have a sense of community. So we found that when we focus not only on the return, but also on the people, that tends to make our projects be really successful. And then when you focus on the people, that turns around and helps your financial bottom line too.
It's awesome, Nick. Super unique, and it's cool. I saw a communication come through my inbox recently about that serving opportunity. Um, so I appreciate you sharing that for sure. And to just round this out, I wanted to ask you a final question here. And I mean, you guys have obviously been extremely successful at Rise 48 Equity, and I'm just curious, what do you think the multifamily industry is getting wrong right now?
Yeah, that's a really good question. I don't know if I have a great answer because I think it's really dependent on the individual. But I think if you jump at every opportunity without slowly going into it, I think that's when people get into trouble when they have to transact on a deal in order to get the acquisition fees to make the deals work. We're typically looking at 100 opportunities, maybe making offers on two or three, and then moving forward with one or two. But we've got a multi-step process to really discern if an opportunity is really an opportunity. So obviously we have certain targets that we're looking for. And if we can hit those in a first, second, third round pass, then we'll do our full due diligence package to really understand if a project makes sense. But probably going too quickly into opportunities and not really taking your time or having a process or a team to really understand if this is a deal that really makes sense.
Right on, Nick. Super insightful. We're gonna make sure that every month we have you back on sharing insights related to, commercial real estate in general, but maybe you can even give us some updates in the market, as we continue to do this. So I do appreciate your insights for sure. And if we had somebody listening that wanted to get connected with you or Rise 48, what's the best way to do that?
Yeah, just send me an email, nick at rise48equity.com. I also write almost daily on LinkedIn, and you can learn from me there. And would love to see if there's a way to help serve you.
Right on. Appreciate that, Nick. Thank you so much for tuning in, everybody, and we'll talk to you soon.
Thanks a lot.